Hey guys, welcome to the Silver Report. Here we are, it's Friday, February 17th, 2017. We have gold currently trading at $1,236.30. Silver is trading at $18.08. And let's get right into some of the economic factors that will be playing a part in the price of precious metals. We have some big news, and we're looking for a metals rally to come right around the corner. Now, what we're seeing is something that took place back in 2008. There was a rerun, possibly, of China's 2008 stimulus. So we saw China's massive stimulus during the financial crisis is set to offer another boost to global metals prices. And so Goldman Sachs is coming out. They're saying the strong credit expansion that has just taken place in China right now, it's remarkably bullish implications for the nation's metals-intensive industries as fixed asset investment, manufacturing, they're all poised to accelerate. So we know that silver is a very highly used metal in industrial purposes, medical, there's automotive, computer chips, cell phones. So new lending to the so-called old economy in December and January, it jumped by 1.1 trillion yuan, 160 billion more than a year earlier. That's equivalent to more than 1.5 years of the U.S. infrastructure package that Donald Trump is planning. So this is big moves. So what we've seen, now we know that China's government, they have their hand in every aspect of the economy. We know they just recently tried to ban Bitcoin because they wanted to control currency outflows. And so they are literally creating more cash on a scale very similar to Japan, taking the same kind of steps as Japan. So their credit is already in a dangerous position. So they're increasing it, but what it means in the short term for precious metals is big moves. What it means for the long term in precious metals is still even bigger news. Industrial commodities, they've enjoyed a rebound in the past year on improved demand from property, infrastructure in China. This is the world's top metals user. Now we saw that the benchmark copper price in London is up 32% from a year ago. Iron ore is doubled from this time last year. The Chinese government has embarked on a massive credit-driven stimulus, and it's in response to this economic slowdown they're facing. So it's boosting credit at a pace they've not seen since the 2009 financial crisis. So we are seeing surging demands. So the resulting acceleration in metals demand is expected to push the copper market, as well as other base metal markets, silver, nickel, zinc, into deficit, leading inventory draws, a tightening of the futures curve, spreads, higher prices. And so we know that China's 2008-2009 stimulus, when the nation embarked on massive infrastructure spending, they were trying to offset the cratering global growth following the Western financial crisis. Believe it or not, they were the biggest victims of the Western financial crisis because no one's being able to buy their goods anymore. And especially with the contraction in retail in the United States, even we saw Walmart's closing. When you see Walmart's closing, you know things are getting bad. So this time around, President Xi Jinping, his government is trying to prop up the economy. They're grappling with growing debt already, overcapacity. So in the long run, this is why it's going to be bullish for metals. So new lending to the old economy in the 2 months to January, it jumped 50%. That's 3.3 trillion yuan compared to last year. So the pickup in Chinese copper demand, it's likely to happen during a period when inventories normally draw due to seasonal factors. This is expected to magnify the inventory draw. It's going to tighten spreads. It's going to push copper into backwardation. We're going to see massive moves in silver. But copper in London, it's traded at $6,051 a ton. And so that's reaching the highest price since 2015. And if the bank is maintaining a price forecast at $6,200 a ton. And so the real danger that we see out of this is we're seeing, for example, China, they're starting to put a price tag on what any collapse in the nation's red-hot property market could cost banks. there's a very serious issue when it comes to credit in China. A drop of 30%, they already have this housing bubble developing over there. So as they heat up, there are some great dangers to this. Though in the short term, we're going to see rising prices on metals because of the jog to the industrial, as well as the infrastructure plan in the United States, and bringing back a revival of manufacturing, attempting to compete with manufacturing. We will see a drive for the price of silver. But we're seeing a drop of 30% in housing prices could cost 4% of total loans worth 4.1 trillion yuan. That's 615 billion to go sour immediately. So this is a very serious issue when it comes to China's housing market. They're already overdrawn. Very similar to what happened in Japan. Everyone thought Japan was going to be the world's powerhouse economy. It was doing so well. And then all of a sudden, Japan is into this issue where their debt to GDP is just massive, and it's irreversible. They continue to have to print money. We see the same thing taking place in China right now. And so such a drop, what we're facing over in the Chinese housing market, it could trigger 4 trillion yuan in delinquencies. It could collapse world markets. And so the risk already is extremely high. So increased credit, on a risk, because we're seeing that the United States is already accusing them of being a currency manipulator, accusing them, and they do manipulate their currency. They're accusing them of trade deficits. Well, we do have a trade deficit. And so what we're seeing, that the bank losses under these scenarios, there'll be a far cry from 1.3 trillion in the US after the 2008 financial crisis. But they're anticipating a banking system bailout that could rock the stock market. It would push up our number two buyer of government bonds into a complete and total collapse. And what we're going to see in the United States, we're going to feel this. So not only in the short term is it great news, and it's bullish for precious metals. Not only silver, but copper. That's looking like the winner this year. But also, it's looking very dangerous for the outcome of this increased credit and the fact that they've been increasing currency liquidation, creating liquid currency into their markets, having to create more QE. And so in the long run, we're going to see it's going to be beneficial then. All right, guys, thank you so much for joining me here on the Silver Report. If you like the content, be sure to subscribe, like the videos, share the videos. I thank you guys all so much for stopping by and watching. And as always, stay safe.